Bitcoin plunges right before the Fed's rate cut, and the market is left in shock while everyone was expecting a bullish push. The price sank hard to $109,200, making it clear something doesn't add up. Powell talks about more cuts, liquidity returns, and yet money keeps fleeing. ETFs see record outflows, institutions shift to defense, and one question hangs in the air. Are we facing the last scare before a rebound, or the start of something much bigger? Bitcoin's price shook the market again this week after dropping sharply to $109,200, just before the U.S. Federal Reserve announced a 0.25 percentage point cut. Even though this move was largely priced in, the nearly 6% slide from its recent $116,400 high caught many off guard who expected a milder reaction. The Fed's message was clear. The cutting cycle will continue through 2025 with at least 3 additional reductions on the horizon and could even extend into 2026, leaving benchmark rates between 3% and 3.25%. However, the crypto market didn't respond the way you'd expect. Instead of rising on looser monetary policy, Bitcoin pulled back sharply, repeating a pattern seen after previous FOMC meetings. First, a drop on uncertainty, then a recovery as traders step back in. During the press conference, Jerome Powell acknowledged the economy is still growing, though at a more moderate pace, and that the labor market has cooled while inflation remains above the Fed's 2% target. The central bank also announced it will stop shrinking its balance sheet as of December 1st, ending so-called quantitative tightening, hinting we could be entering a new phase of increased monetary stimulus. In theory, that should favor risk assets like Bitcoin, but in reality, the market seems more focused on protection amid global uncertainty. And that uncertainty has first and last names: Donald Trump and Xi Jinping. Both leaders met recently in South Korea to try to cool trade tensions between the United States and China. While the meeting didn't deliver major announcements, it did convey a sense of easing. Trump said negotiations are progressing positively and that he expects to maintain a fantastic long-term relationship with China. The backdrop to this meeting is, of course, preventing a global economic downturn. In recent months, tariff disputes have hit the technology and energy sectors particularly hard, and their effects have spilled over into crypto, where Bitcoin fell from $121,500 to $103,000 in mid-October, dragged down by fears of a worldwide slowdown. For now, Washington won't impose the 100% tariff on Chinese goods that Trump had threatened, while Beijing may respond by easing controls on rare earth exports and increasing purchases of U.S. soybeans, a symbolic gesture of cooperation. These decisions also matter for the crypto and artificial intelligence industries. Tariffs and restrictions have made mining hardware more expensive, with Malaysia facing a 19% tariff and raised concerns about bottlenecks in chip and server manufacturing. In short, the Trump-Xi meeting aims to stabilize a relationship that, if it tightens again, could continue to weigh on global markets. Meanwhile, spot Bitcoin ETFs recorded one of their largest single-day outflows since launching in the United States, $470 million in just one day. And that deserves attention. The biggest outflows came from funds run by Fidelity, ARK Investment, and BlackRock, though even Grayscale and Bytewise saw redemptions. What's striking is that this turn comes right after strong inflows earlier in the week, signaling a sudden shift in market sentiment. In total, the ETFs have accumulated about $61 billion in net inflows and manage $149 billion in assets, nearly 7% of all Bitcoin in circulation. That's no small feat. Despite the volatility, they remain key players. BlackRock alone holds more than 805,000 Bitcoins. And speaking of institutional investors, Strategy, the company with the largest Bitcoin holdings in the world, could be on the verge of a historic milestone: potential inclusion in the S&P 500 before year-end. According to a 10x research report, the company has a 60% to 70% chance of being added if it delivers solid third-quarter results, which are due today, Thursday. An accounting gain of around $3.8 billion is expected, driven by the increase in the value of its Bitcoin reserves. If it happens, it would be a huge step for the sector, bringing cryptocurrencies even closer to the heart of traditional finance. Just think about all that liquidity pressing on Bitcoin's demand. What would happen if MicroStrategy were added to the index? Even so, risks remain. The MNAV ratio, which compares a company's market value with its value of cryptocurrencies, has deteriorated across several firms in the sector. When this indicator drops below 1, it means the company is worth less than its own digital assets. Strategy, Bitmain, Metaplanet, and DeFi Development Corp are among those affected. In October, Strategy bought just 778 Bitcoins versus 3,500 the month before, reflecting a more cautious stance after roughly 19 $19 billion in crypto market drawdowns. That said, according to 10x Research, we're right at the point in the cycle where liquidity returns, which could foreshadow a new bullish push. And of course, we'll assess and analyze this from the Crypto Insight perspective. Amid all this, S&P Global Ratings has just assigned Strategy a B- credit rating, still speculative, but with a positive outlook. It's the first time a company with large Bitcoin reserves receives a formal S&P assessment, and it could mark the start of a new phase of institutional recognition for the entire crypto ecosystem.
Now, let's break down the crypto ecosystem. Look at Bitcoin's chart. From the most recent high, we're seeing about a 7% drop in price. And this is playing out across the whole ecosystem, as you can see on screen. Frankly, the recent volatility hasn't been kind to the markets. Here's our take. On one hand, retail investors are buying, and on the other, major institutions are selling hard into the space. And this is happening while, for example, Bitcoin is breaking through a key defense zone. You know what usually happens when a support zone is lost? A deeper sell-off tends to follow. Honestly, the short-term outlook for crypto doesn't look great. Take XRP. It's almost an open book, your guardian angel. After this accumulation phase, notice how once it broke the creek, the price struggled to keep pushing higher. In fact, by studying what big institutions and retail were doing throughout this entire range, we had already framed a base case where price would, at the very least, have to fall back to structure, to the creek. They're definitely trying to scare the market right now, but notice how XRP, just like Bitcoin, is sitting at a key structural level. From here, it's basically two paths. Either we turn up immediately, right now, and kick off a proper bullish party, or, in the short term, things could go south fast. Look at Solana. It's also at a critical structure. Better, it turns out to be a fake out, so we can say nothing happened. As you can see, the entire crypto market is at a delicate point, and as I showed a moment ago on the XRP chart, whales appear to be selling, while retail investors, that makes our hair stand on end. Take BNB for example. I really don't like this little trap. After a bearish impulse, we get a pause, they spring the trap, and now we'll see if they want to deliver a replica move. We're gonna watch all of this very soon. Honestly, if we analyze the total crypto market cap chart, there's nothing worse than watching a potential flat correction fail. At best, sure, come grab a bit of liquidity and then get out. But when that idea fails, the most likely outcome is the bleeding continues. Total 2 is warning us of the same thing, the market cap excluding Bitcoin. And Total 3, which should have done a simple test of the creek before continuing higher, has left us empty-handed. So who's causing all this? As you can see on Bitcoin's 1-hour chart, it's the whales. They started selling hard after the trap that should have been a flat correction pattern. I'll break this down in detail for you now, and I'll show you what Ethereum and XRP are doing too. Specifically, what whales are doing and what retail is doing. But first,
I want to introduce you to our private Telegram channel, which is completely free. In fact, at the time of recording this video, we're also live streaming for the community. During these live sessions, we look for trading opportunities in the futures market. We focus on intraday trades, and within this community, members also share their operational ideas, what they're working on, and what they're looking for in the markets at any given moment. It's honestly very interesting. This community is constantly learning and improving. So if you're an active trader and tired of trading alone, you can join our community. It's very simple. The requirements are as follows. You need to be a user of BitUnix or BuyDFI, have deposited cryptocurrencies into your BitUnix or BuyDFI accounts with a minimum value of $100.00, and use this account as your primary futures trading account. In other words, you need to be actively trading. Once you've met these requirements, simply fill out the form displayed on the screen. It consists of just 5 simple questions, and we'll get back to you as soon as possible. I'm leaving you the BitUnix promo details and the Crypto Insight Premium Access form in the description and pinned comment of this video.
as I was saying, look at what whales and retail are doing with Bitcoin. Notice this micro distribution phase for BTC. See how when institutions decided to break the creek, that was precisely the point where their selling clearly began. At the very moment when retail, reckless as always, and jumping the gun, was starting to buy, we got an almost unmistakable signal that the market was likely to tumble. And here's the key. Retail's trend is to keep buying, while institutions' trend is to keep selling. As long as that doesn't change, the bearish force remains dominant for Bitcoin. And when it comes to Ethereum, it's exactly the same story. Retail is buying the entire drop poorly, while institutions are selling into it. And right now, it even looks like they're loading up more sell orders. Even if we get some bounce or a brief correction, the path of least resistance is still down. All of this lines up with the structural view I shared a moment ago and with what you're seeing now on the charts, where we compare smart money's behavior against dumb money, retail. Look at Ripple, XRP. Notice how, quite clearly at this point, institutions began selling, right as retail was already starting to buy. It basically started by getting it wrong. And what did price do? It tanked. That's why in our recent Crypto Insight Premium live sessions, we were anticipating anticipating this drop. Now, to be honest, after the fall, we wanted to see a retest, and from there, head lower. But the latest burst of volatility didn't let price behave that way. In fact, institutions keep pressing hard while retail keeps buying like a maniac. So we'll say this is more plausible for Bitcoin and crypto in the very short term. Because key structures are being lost, and because institutions are still squeezing, it's much more likely that crypto and Bitcoin keep falling in the near term. Now tell me, what do you think about the market right now? Drop your take in the comments. And if you enjoyed this advanced technical analysis, like the video, subscribe to the channel, and click the bell so YouTube notifies you of future uploads. Good luck with your trading, and see you next time.